the investment guru, made a point that since the market is too much expensive, that right now is sitting on so much cash that he don't know which stock to invest in because everything is very expensive. On the other hand, one of my mentor and another very profitable investor and a trader, Khoo. Most of you know Khoo. Great teaching, great teacher, great mentor. As a different argument that he's saying that actually the market is not overpriced, the market is not too expensive, and there is a lot of opportunities in the market right now. So in this video, I'm breaking down the Warren Buffett perspective on the investment right now and Khoo argument on why the market is still not expensive and why he feels there is a lot of opportunities in the market. But before I get to that, just watch this part where Khoo is critiquing Warren Buffett, and then from there we will continue analyzing the both sides and we see, is the market really expensive or is the market really cheap and with a lot of opportunities to make money right now. All right.
Just a few days ago, during the Berkshire Hathaway annual meeting, Warren Buffett once again said that prices in the stock market were too high and he didn't see anything to buy. And right now, his company has accumulated over $397 billion in cash without having anything to buy. So is this a signal for you as an investor to get out of the markets, to not buy anything because, the markets are too expensive? Well, let's explore that. In quite a number of people who have been staying out of the stock markets for quite a while and they've missed out on the huge rally in the markets, and by staying in cash, they're seeing their purchasing power erode because of inflation. And then the reason they give is because they say, oh, the stock market is too expensive. And it's not something new. They've been saying this for the last 2, 3, some people even 4 years. And when you ask them, why is the market too expensive? They say, look at Warren Buffett. He's one of the greatest investors in the world, which I don't agree with, right? I'm a loyal Buffett disciple. And Buffett, for quite a while, I think now for over 1 year, he's been a net seller of stocks and not a net buyer of stocks. And he's also said for quite a while that there's nothing to buy, there's nothing to buy. And again, just a few days ago, he reiterated that by saying that stock prices are too high and the stock market now is looking more like a casino than a church, right? He likes it to be like a church where people stay and they are loyal, but casino, they go in and out. And as a result, his company has now accumulated $397 billion in cash. So there are a lot of people who read it as a very bearish sign that he's giving, that he's saying that things are too expensive and he's waiting for the market to crash. And people think that Buffett's predicting a crash, and that's why he's holding so much cash. Now, for someone who's a loyal Buffett devotee and someone who has read everything he's written, I've watched all his videos many times. I've followed Buffett now for 30 years. And one of the things I can tell you about understanding Buffett's philosophy is he doesn't attempt to predict the market at all. He keeps saying that I've got no idea where the market's going to be next week, next month, next year. He's got no idea, right? But what he does is that he only buys companies that he understands that are high quality companies when they are undervalued. So the reason he's not been buying anything, he's holding so much cash, is because frankly, he can't find anything that's undervalued.
So to understand why Warren Buffett is not buying anything right now and why he's sitting on so much cash, we have to go deeper and explore on Warren Buffett investment model and the criteria that he uses to identify very strong companies that he can put his money and sit down like a church member where every congregation is joining in and knowing that this is the road to heaven, or now in financial terms, this is the quality stock that I'm going to invest on and have a surety that I'm going to make a money out of it. All right, let's see, is Warren Buffett right that the market is quite expensive right now, and what is the strategy that Warren Buffett uses to identify his stocks that he invests in to make money. All right. So Warren Buffett only invests in companies that have very strong financials. Okay. So you can only make money if you invest in the companies that are generating revenue. And revenue is the total money a company that makes from selling its product and services, okay, before any cost. So the key idea is that this one shows the size and the growth, okay. It doesn't literally mean the profit, because a company can be generating a huge revenue but its expenses are so high that again it end up making losses. But generally a key metrics, that is revenue, will just show the size and the strength, okay. 2, on the financial metrics, we will analyze the operating income, okay, the EBITDA. Okay, the operating income is the profit after operating expenses, okay. So the company make its sales, it get the income, and then out of this income that it gets, it pays the salary, the rent, the production cost, all that. That is the operating income, okay. So it shows how efficient the core business is. So if again it has more operating, if it has more operating income, then it means it is stronger. All right. So you want to invest on only company that again has a very strong operating income, okay, and not measured just in 1 month or 2 months. It has a clean track records, maybe let's say 5 to 10 years. Okay, that is what we are analyzing, 5 to 10 years. So if it has been consistently having a huge operating income for 5 to 10 years, then you have more confidence that you can invest in this company. Okay. 3, we analyze the net income, and the net income is the total or final profit after everything is deducted. Okay, so the operating costs are removed, the interest on debt and the loans are removed, the taxes are removed, and other expenses, whichever expense will be there. So this is now the real profit, okay. This is what gets reported in the end lines. So you find a company like the one that operates the airlines. The airlines like Singapore Airlines, you find them, they collect a lot of revenue, but then the running costs are too high, okay. You find the running costs are extremely high, like the fueling, the machinery, and then it end up having a huge debt again, and the profit shrinks. So it makes it arouse a company to invest in, and that is the reason why I never invest in the airlines. Look at the Boeing operating costs are too high that it barely reports any profit. Another very crucial thing to check in before you invest or buy a stock from any specific company, the free cash flow. Very important, the free cash flow. So the free cash flow is the actual cash, that is left after running the business and maintenance asset. Okay, so you have spent all your money, okay, and now you still have more money in your hand. Okay, so it is the operating cash flow minus the capital expenditures. Understand? So it matters because cash is harder to manipulate than the profit, and it is used to pay dividends, to buy back shares and reinvest. Okay, so a company can have a high net income but low cash. So if, let's say your company is running the Boeing example, it has a net income from the travel income it gets from the customers traveling all over the world, or the sales of the aircraft. Let's talk about the sales of the aircraft. But then it has low cash in hand to expand or to maintain. So it's a red flag, and that is why you find that the Boeing workers are from time to time striking. Most of the time the US government comes in and step in so that it can get it out of the debt. Okay, and that is why we are saying, okay, Boeing, you are making a lot of sales in the aircraft, but why again are you in financial struggles? It's because they don't have a free cash flow. So these are just the examples that I'm giving on the financial metrics, so that you can only invest in top 1% of the companies out there, and you can make money. Okay, and this is what Warren Buffett has been doing, and he has been investing in a company like Coca-Cola, and we shall be internalizing the Coca-Cola financial metrics, and you find that all the revenue are going up. Okay, the earning per share is moving up again. It is consistently having free cash flow, and that's what makes it a great business that Warren Buffett has been owning for many years. Okay, so strategy number 2 to identifying great companies to invest in: strong economic moat. Okay, and what is a moat? So in history, the moat, you find a king built their castle inside the rivers, or the dig trenches around the castle, and in these trenches they set in the mines, and up in the castle we have the soldiers having the arrows. So if the enemy start coming in, by the time it goes into trenches, they get killed by the mines. Okay, and the rest that are remaining, the enemies, the soldiers up there, they just draw and pierce them with arrows and spears, and that is how protected the castles were. Okay, so when we are talking about the business itself and talking about the economic moat, we are talking about how is this company protecting itself from, or defending itself and its profit from the competitors. And these are the specific things that makes a company strong or have a competitive advantage, or what we are calling the moat. Write this down. 1, the network effect. Okay, so what is the network effect? The product becomes more valuable as more people uses it. Okay, so the key idea is to attract more users for exponential growth. Think about the Meta, Facebook. Think about the WhatsApp. You know, it can reach a lot of friends, and you don't leave because your friends are already there. Okay, so it can reach a lot of people. So, and that is why it makes the companies like Meta very strong. Okay, 2, the switching cost, and why this is a great economic moat. It is painful, expensive, and inconvenient to switch to another product. Let's say one of the company is using the Microsoft services, that is the Microsoft Excel, the Cloud, and all that. Okay, so even if another product comes from another company, this company finds it's difficult to switch to another product, because again it will have to move its servers from Microsoft, to move the data from the Microsoft again. So it becomes painful and inconvenient. You don't read, because time, money, retraining and data migration is too much, so you have to stick with that. And the switching cost, that is where you find companies like Microsoft, again, they have been existing years over years without moving. The Oracle system again. Okay. Barriers to entry, this is another economic mode aspect. So and what is the barriers to entry? What does it mean? It's something that makes it hard for new competitors to enter the market. All right. So you have established yourself, and other companies, small companies, cannot come and lift you off from that position. It protects the industry from the new players. You understand? And this will look like high capital, too much money needed. Okay, regulations and licensing very expensive, and technology or the patents, right, that are needed again. So Boeing, again, I gave it an example. You need a huge capital and regulation to run the Boeing company and the aircraft companies again. Okay, so the competitors find it's expensive and difficult, and they leave you alone, so you're enjoying that part of it. Let's talk about the brand monopoly. And brand monopoly, this is where customers prefer a brand, so strong that they will pay even more for it. Okay, they will continue buying it even if you increase the prices of your product. Okay, the key idea is perception is equal to the pricing power. Okay, for example, every year Apple releases a new version of the Apple phone, and it is always expensive. But then they have the branding is so high that the customers don't switch, because they trusted the status and their identity. Okay, so just in summary, when we talk about the network effect, we stay because others are here. Switching cost, stay because leaving out. Barriers to entry, others can't enter. And then the brand power, stay because I want this one. These are the key metrics when we are talking about the strong economic moat again. All right, this is what Warren Buffett teaches us. And when he says that he can't invest right now because he has accumulated enough shares in the great companies. When Warren Buffett says that I can't find a great company to invest in right now, he is looking at this strong economic moat, and he doesn't see any current company or emerging company that qualifies the top 1%. All right, if you follow these methods again, if you follow this strategy, you'll find that you are making more consistent profit and trending with more confidence. All right, okay. In part 2 of this video, we will be discussing 2 important aspects. One, why does Adams-Co feel like we have still a lot of opportunities in the market that we should be taking opportunity of and making money out of them? And the second part will be, when do Adams-Co and Warren Buffett buy? Which are the criteria and the conditions that they have put forth, that if the conditions are fulfilled, then they enter a trend? When do they buy? Okay, already we have established what to buy, and this is similar criteria that Adams-Co and Warren Buffett uses. And the second part now, we want to ask ourselves, when do Adams and Warren Buffett. So stay tuned to my channel, click to that like and subscribe button so that the moment I upload that video, you can watch it and learn from it. Thank you for watching.